April will be a really important month determining where the price of oil is likely to go. If it stays at these levels or comes down a bit, we think this is manageable. But if it stays at these levels for significantly longer or moves higher, then global growth will be at risk. Welcome to Key Points for April. This month we look at the impact on growth from higher oil prices. We turn our attention to the financial tightening that we've been seeing in recent weeks. And we ask the question about equity markets. Will they manage to avoid a sharper correction than we've already seen? Now, turning to our first point, global growth came into this Iran crisis in very good shape. It was supported by capital spending, it was supported by government spending, and it was supported by a fairly benign interest rate environment. Now, that's an important starting point because that allows the global economy to cushion many shocks. And of course, what we're seeing in Iran right now is a major shock to that. But we do think the economy or the growth dynamic will manage to weather that. It is going to be a headwind, but nonetheless, we think that growth will still hold in and we're not expecting a recession. Now, if you look at the chart I'm showing you here, this is oil prices. This is looking at the forward market in oil. You can see actually prior to the Iran war, oil prices were pretty flat looking out basically for the year ahead. They were at low levels, and again, the market wasn't expecting any significant move higher in those. Of course, what we've had is this war has created a massive shock, and we see the price of oil, the spot price today is around about $115, but you can see here the market pricing is that price will decline over the months ahead, getting back down not as low as we were, but certainly to a much lower level than we're at today. Now, is that likely? Well, if you look at the last example we had during the invasion of Ukraine, you can see there was a similar pattern. The price was actually significantly higher, about $130, before it started to decay. Now, the reality was it stayed higher for a bit longer, and then it came down sharper. We're not sure of the situation that we're going to be in the next month or two, but April will be a really important month determining where the price of oil is likely to go. If it stays at these levels or comes down a bit, we think this is manageable. But if it stays at these levels for significantly longer or moves higher, then global growth will be at risk. Now, turning to our second point, financial conditions have actually tightened quite considerably in recent weeks. Investors have become more concerned about inflation, and we can see this in the chart that I'm showing you here. The rising price of oil, of course, has also been reflected in higher fertilizer prices and helium prices, all of which go through the Strait of Hormuz. And that's resulted in investors repricing where they think central bank policy rates are going to go. In the case of the Fed, you can see we have moved from expecting about 2 rate cuts to actually rates being on hold or possibly even rising in the months ahead. In the case of the Bank of England, which is quite dramatic, the 2 rate cuts that were expected for this year have changed to market expecting at least 2 rate hikes. It was actually 4 rate hikes just a week or so ago. So the point about this is there has been a shift in financial conditions. We think some of this is a bit overdone, but nonetheless, this means that financing costs are becoming higher. Bond yields have moved up about 50 basis points in terms of 10-year yields across most markets. And this, combined with higher credit spreads, a slightly lower equity market, means that financial conditions for companies have become a little bit more challenging. And that is going to be a headwind for growth going forward. Now, turning to our third point around equities. So far, we've seen a fairly modest decline in equity markets given all that's happening in the world right now. And we do think there's a bit further downside potentially ahead. If you look at the chart I'm showing you here, you can see, yes, we know markets have been in a strong uptrack really for the last 3 years. But the war in Iran, of course, has resulted in some profit taking. And you can see, for example, emerging markets, which had been very strong at the start of this year, they're down about 12% in recent weeks here, but they're still up over the year to date. And in the case of some of the broader markets, the world index, the US indices, they're off about 9%. And in the case of Europe, about 8%. The point is that these are not massive declines given the big impact we're seeing around the world from the situation in Iran. So investors have been cautious, but they have been very orderly in their repositioning. We do think if this war were to drag on a bit longer, there's likely to be more money coming out of the market. So far, we've seen rotation. We haven't really seen an exodus. So this is something that we need to keep an eye on. And it does make us be a little bit more cautious right now. We think there's the potential for the market to slip a bit further before stabilizing. Now remember, you can read the full report as always on Zurich.com, and I look forward to speaking to you again very soon.